is part 2 of our 3-part series, and we're with Jill Bartoletti from Movement Mortgage. Thanks for being with me, Jill.
Thank you for having me.
We invite people to look back at the first series that we did, which was answering one of 3 questions that people have on their mind. And we actually want you to watch all 3 series because we think there's some good importance here and some information you can pass along to your friends and family if it may not apply to you specifically. But let's answer question number 2 that people always have on their mind. And that would be, I want to wait for the interest rates to come back down below 4%. I feel like the world is going to change and I'm waiting for that. And I'm not going to make a move until they come back down. We must have some strategies around that, right?
We do. We do. And I think the big piece is to understand that if you really want the rates that existed in the sub 4%, sub 3s, you could be waiting a very long time or possibly waiting forever for that to take place again. So when we look at that, we have to think about the opportunity lost. And that's huge for people to understand. And there are ways that we can look to avoid feeling the pain of where rates are right now. You know, we do know that rates are at a peak. Inflation is at a peak. We also know that inflation will not stay this high, and therefore interest rates will not stay this high. And so it's around working around a strategy that gets us from today to your forever loan. More so, marry the home that's the home of your dreams. Date the rate, meaning buy a home, accept where your payments are, make sure it works for you, and know that when inflation comes down, so will your rate. And so will your payment.
And I feel like that's starting to happen right now. Yes. I saw in the news this morning that the interest rates ticked down slightly. That's always a situation. We can never really predict where the interest rates are going to be. I get that. But they're starting to plateau a little bit. And it's hard to imagine what they can do. But I really don't see them going down below 4% unless something drastic, horrible happens, and we don't want that to happen.
No, I think it'd be really wise for us to plan to do something in the 5s to the very maybe upper 4% range. I feel as though that is a better plan for us to have, and that could have a great economy around us while we're doing so. So I think that that's a better course for us to look at. But if you're looking at interest rate and that is truly your barrier of entry, and you think your payments are simply going to be too high, and you just want to wait for rates to come down, 2 things to consider. First one, when rates come down, there's a lot of individuals who have the same mindset. I'm going to wait and I'm going to buy when rates come down. You may walk into a market where you are once again competing on a home because when rates come down, people will understand that now is the time to buy. You could pay $100,000 once again over the asking price of a home because people are all flocking back to the market. And you may have missed that opportunity to spend or to pay far less on a home. And the difference in what you pay for a home versus even a year at a higher interest rate on a loan is dramatically different. The price of the home is where you really need
You've got a powerful tool up your sleeve. The 2-1 buy down, the 3-1 buy down. Tell us more about that.
Well, if you're looking to bridge the gap, today's rates to get us past, and we see rates come down and we can refinance. So let's talk about a buy down. We have the ability to have you or the seller, the seller can also do this with a willing party, can prepay the interest on a loan for up to 2 years or even a 3rd year. So hypothetically, we lock your loan at 6.25% today. The very first year on a 2-1 buy down, you would be at 4.25%.
Did you say 4.25%?
I did. Now, if we did a 3-1, I get to use the number of 3.25% as your rate. Yes. And all of a sudden,
audience is listening to this.
Yes. All of a sudden, we're back to hearing those rates that people want to hear. 3.25%, 4.25%. Now, in a buy down scenario, each year you pay that rate for the actual full 12 months. So 4.25% for the first year, 5.25%, then you land at 6.25% if we're doing a 2-1, and the 3-1 works the same way, but that first year is 3% lower in rate. And you have these wonderful years of lower payments getting you from today to when we see the market decline in rates, and you have an opportunity to lock in your forever loan.
Now the buyer has to pay money to get this done. It doesn't magically happen.
They do.
That's
Now
where,
that money is held in an escrow account, and then that money is put in there, and every month a little bit comes out to supplement your payment and the difference between the rate you are locked at and your buy down rate. Now, if you were to sell or refi during that first 2 to 3 years, you don't lose those dollars. Those dollars in that buy down account will be applied towards your loan payoff.
that is
So they
so
know.
important. I'm gonna actually rephrase that, paraphrase that. So let's put it into reality mode. I have a client. They want to have that 4.5% interest rate. So we're going to do a 2-1 buy down. So it costs money to do it. I'm just going to take a stab in the dark. We have to find out from you exactly the number, but let's call it $25,000 to
And
buy.
it could be far less. It has to do with your loan amount and sales price.
Exactly. We don't know. So it could be $25,000. That 25 grand sits into an account you just said, and you don't lose it. You pay for it up front in the closing costs when you purchase it.
You do, and that account is
You
funded.
don't lose that.
No. And every month there's a small, there for the deviation between your actual rate you locked and the buy down rate, there's an amount that's taken out of that account every month of that 25,000 to supplement your payment you're making and make it whole between the buy down rate and your locked rate. And so depending on how long you have that loan, there's still money in that account. Only if you ride it out the full 24 months on a 2-1 buy down would that account come to zero. If you refinance prior to that, there's money still remaining in there.
That's pretty cool. All right. So now a client, I find it fascinating that a lot of clients still think you have to have 20% down to buy a loan. So instead of them thinking they have to have the 20% down, I want them to be thinking about, they don't have to do 20% down. They could do less than that. And I'll let you speak on that, but they can take those funds instead and use it towards this buy down. Or we're in a market right now that is a pretty good chance the seller will pay that dollar amount. They could pay it for them for the buy down, right?
They do have the ability. Yeah, all loan programs offer the ability for certain seller concessions. This is considered a concession. So yes, it does have the ability to be funded by a seller.
Because we have sellers that are allowing you to buy contingent on the sale of your home. They are allowing credit concessions like for a buy down or a carpet allowance. They're allowing buyers to do inspections now again, where instead of buying it sight unseen and crossing your fingers, you don't have water in your crawl space or mold in the attic. So these are options that are real options for folks to get them down to that interest rate of below 5%.
Absolutely. Absolutely. And it can be a buyer seller funded. Seller can fund a portion, buyer can fund a portion. We can find a way to bring that rate back into a range that the buyer feels as though they are winning on all, on all fields.
And can we talk about the myth that you don't need 20% down to buy a home? Can you please address that myth?
I'm gonna dispel the myth. You do not need 20% down on all loan programs to buy a home. If as a first-time buyer, you need to typically put down between 3 and 5%, depending on your sales price. You can certainly put down less, even as a subsequent second home or a purchase of your next property. 5% on all conforming and high balance loans. Those are loans up to almost $1 million that you can put 5% down and be a buyer. Some of the larger loan amounts exceeding $1 million, they're going to want a little bit more money for a down payment. But the thought of waiting until you saved 20% down could really end up taking away opportunity.
Waiting for the world to change on that.
Yes.
Exactly. And then the veterans still can participate in this 2-1 buy down, and they're doing the 0% down program.
Yep. Your VA transactions certainly have the ability to look at things in the VA environment too, and sometimes with FHA as well. You may not even need to do a buy down. Those rates are already starting out of the gates lower than most conventional conforming loans. So there is a wonderful reason to still consider those. And with VA being 0 down for people who can have that entitlement to do it. Mm-hmm. And FHA just recently revised their mortgage insurance.
Right.
Huge, huge change. It now aligns more so with the conventional loan. And so there, people are coming back and providing programs and relief in areas that consumers may not even be aware of.
Yeah, some real good solutions out there. You know what another really good solution is? So here's the other thing I hear. Well, what if I'm in the middle of shopping for a home and we find one, we lock in on the interest rate and the interest rates go down? What tool do you have for that?
Well, I would tell them that we really pride ourselves in being very accurate with the market. It is something we watch. In fact, I have a ticker on my screen right now while we are talking, and we keep a really good feel. So up front, we always want to give you the best possible advice. And maybe we don't lock immediately when you get in contract, but you will understand the risks, the rewards, and the possibilities. Now, if we do lock and something crazy does change,
Yeah.
lenders will allow you to bring that rate down and float it more so to current market. Now, these are circumstances that are big swings. Like if we saw a big change, lenders will definitely do so. Fractional changes, we don't often see that float down, but if you see a big move in the market, we are here to make sure that you win. It's not about anyone else but the client. So we are always watching, and we are always, doing everything we can to bring that down.
You definitely have tools in the toolbox for the clients to come up with those solutions of these questions. All right, so that I think sufficiently answered our second question. Now we have that third question that people always ask about. So we'll end this session and move on to our third video session, which will be talking about, I think I'll wait. I think I want to rent and not have to jump into buying because I feel like the prices will come down and the interest rates will come down. I know we've talked a lot about that, but I really want to talk more about the aspect of being a renter. So when we come back, we'll talk more about that.
That sounds good.